I'm a great believer it's not official until it's officially denied. And the Hong Kong's de facto central bank, Eddie Yu, said the peg has worked very well for 40 years and there's no plans to change it. And that rang the bell for that very point that Brent made about the Swiss National Bank in December, just before Christmas, saying it was central to their policy, and then walking within 3.5 weeks. The 14th of January, the peg failed in 2015, after saying in late December 14 that it was central to their policy. So the fact that he has to comment is the indicator, not the content of what he says. He talks his book and serves his masters. So that content is always going to be in that line. But the fact that he needs to comment is your indicator of stress. Just for a lot of people that are only just kind of getting into the whole Hong Kong story and China and all of that, a bit of the history. It's been a conduit of capital to Asia in general, and more specifically to China. So demand for capital from mainland companies, that's China, has been desperate. Cash need has soared at the moment. However, conduit no more. Hong Kong's ability to provide that capital has dwindled. So much of its status as an Asian financial hub is being undermined. Why is that? That has come as a result of the undermining of the rule of law. And the Hong Kong riots and a lot of this, people have become aware that Beijing can hijack an individual out and take him to face legal proceedings in mainland China. This has caused a great degree of concern. And as a result, there is a capital flight. And I will make a point why I believe that that is a proven point, which will include the Hong Kong 33 and the Hang Seng. Bank deposits falling. The benchmark Hang Seng is down 40% since 2018. And the 8-share index of mainland Chinese equities is below the GFC, the Great Financial Crisis. So imagine if US indices were at that level, just to give you an idea of the stress and strain and capital fleeing the region. A couple of reasons why there's problems with pegs. The monetary policy is the Fed for a place that's the other side of the planet. You do not have power over your own monetary policy. And you can have a situation exactly as we have, where you have America tightening and they are in a different stage of the economic cycle, and it causes a lot of deflation. So a couple of key points for people's understanding there.
Again, for people who are new to this and are trying to learn, you can look up a phrase called Triffin's dilemma. And Triffin's dilemma is a theory that states whenever an individual country's currency is also used as the global reserve currency, at some point in time, there will come an event where the needs of the domestic economy come into contradiction with the needs of the global economy. And that's exactly what we are seeing right now with much of the world. The U.S. needs to tighten monetary policy for domestic issues at the same time that the rest of the world does not necessarily need that or can necessarily sustain that. And so we're kind of right in the heart of Triffin's dilemma, especially with regards to the Hong Kong dollar peg. Sorry, Francis, I'm going to let you go ahead. I just wanted to get that in there.
No, 100%. It's got to come into it. So just a couple of key points. What you're seeing above is the Hong Kong 33. This is an equity index, popularly known as the Hang Seng, and then this is the peg. Bear in mind, they're in a range band. What we've observed is when you have the macro sell-offs, and I'll clarify this, the big sell-off there, the line in pink, when you have the big sell-offs as you did there, that was the 2008, you can see we moved up. Not a huge amount on the peg, but this was the last really harder. There was a sort of semi-official level there that we've since leaked a little higher on the peg. You can see the sell-off on equities there. Again, you can see the USD Hong Kong. So that's the dollar going up and the Hong Kong dollar going down with its indice. So that points to not only is the equities being sold, but it's probably foreign direct investment into the equity market, and it's fleeing the Hong Kong dollar as well as exiting the equity market. So this is a problem when large moves in your equity market are being driven by international sellers. Where I am now in South Africa has had a similar problem, and they're very familiar with the concept of flight capital. Big sell-off in 2016. 2016 was very interesting. We had what Jim Reichardt referred to as the Shanghai Accord. In essence, that was when China maxed out on debt. It had created an immense amount of heat in the globe during the GFC when everyone else was as cold as ice. Bought up, sustained Australia immensely. They skipped through the GFC, buying up copper and ore. Then they hit the buffers on being hyper indebted, and there was an unofficial meeting of, I think it was the G8, G10, G20, God knows, of the top financial ministers, and they came out with a plan. Again, as I say, you reach for the top on the sell-off of the markets, and now we have a shooting star at that point, which was very much the lower band. And then we've had a sustained sell-off period here, and you've gone right the way up to the high point now. I will, in the next chart, show you what is happening in what I refer to as an inverted HVF structure on the Hong Kong index. Please understand that when you're at the top of this range, on an ongoing and continuous basis, the Hong Kong Monetary Authority is having to sell its USDs to buy back its domestic currency to maintain that peg. So it is burning dollars.
Sorry, I'm going to jump in again. I'm very glad you brought this up right here, Francis, because for people who are not familiar with the way a currency peg works, they can all be a little bit different. But essentially what they're doing is in this case, when US dollars come into Hong Kong, they're exchanged for Hong Kong dollars so that capital can be used in Hong Kong. Then the central bank has those dollars either in reserve or on tap. They then use those dollars to buy their own currency to artificially make their currency stronger. And so that is the way a peg typically works. And again, they can be arranged slightly differently, but that's essentially how a currency peg program is structured. Anyway, sorry to interrupt. I'm going to let you get back.
No, keep coming in. I love it. This move from the one side back down here was the event of 6 to 7 trillion being printed. And it's the only time we've seen such an abrupt sell-off, and it's understandable. So when that process post-pandemic occurred, we created enough funds for the world, not for America specific. So the Fed's role on a global stage can't be underestimated here. So going to the lower down time frame, I'm highlighting the same thing on a 10-hour chart, which is a bit peculiar, but I wanted to get the setup in structure. Again, you will see the movement to the top end of the range, and you can see it associated with bearishness on the Hong Kong markets. And there's a reason why I brought it to this time frame, and I'll be showing you in the next chart, because there is a technical squeeze and a breakdown. So on the lower time frames, on the 10-hourly, I'm illustrating that again, that relationship holds regarding flight capital. Shares are sold and the money is going offshore and the dollar is being sold. We're seeing that push up. So the blues are showing you the deval of the Hong Kong dollar against the USD, and the sell-offs in the equities are very, very coincident. So this proves a point of flight capital and money leaving both the equity space in Hong Kong, but also leaving the territory as a whole, which is seeing the pressure come through then on the Hong Kong dollar as well. So with that in mind, I'm now just showing you the Hong Kong dollar on a daily time frame, a more traditional time frame for most people. It's already had a big period of selling off. This structure is a downside continuation structure. This is part of our bespoke methodology that we do. Those that wouldn't want to have a trade that's holding against the FX could actually trade the Hang Seng short. There's no one trying to hold the stock market up. Well, not in the same manner as the Hong Kong Monetary Authority is trying to hold the peg down. But this is a downside trade. If we were to trade from where we are, and this is funnel levels, this red and green lines are in and around the 20,000 zones. We've already triggered this, run our interim target at a small return move. And I talk about 5 stages of a breakdown. So we typically get a very timid step over a level and then a return move. This is early doors when it tests a level. So stage 1, stage 2, break and feign, return move. Stage 3 is the capitulation phase. It's often very, very quick and brutal. So the exciting bit in terms of fast movement could be coming quite soon. So you could see again a move here, small amount of wind up, and then you have a spill, typically from our first interim to at least covering the second interim. So that is quite a lot of loss to the downside that comes. This is going to imply given what I've shown Ref Flight Capital, that this is money exiting, not just the Hong Kong market, but the Hong Kong territory as a whole, it's going to mean that an accelerated rate of dumping dollars by the Hong Kong Monetary Authority in a bid to protect its peg. So not only have they worked at what glide rate they're at, that glide rate is going to get a lot steeper potentially, and that's going to focus minds immensely in terms of the viability of the peg.
For people who aren't as familiar watching currencies and what can potentially happen, we saw the yen earlier this year lose a lot of value, and it did it in a very steady manner over a number of months. That is not possible with a currency peg.
Correct.
You will see the currency peg stay flat for a long time, and then it will just disappear, and you will see a massive move very quickly. It was able to happen that way on the yen because there was no currency peg. But if we're talking about the Hong Kong dollar, the fact that it's sitting right at its band level for a very long time shows that without the band, it would be doing exactly what the yen did earlier this year. But it's the peg that keeps it flat. Anyway, I'm going to back to you.
No, I love that. And I refer to it as the dam wall breaking scenario. You either let a river run and it trickles on, as the yen did, or you dam it up and you hold it artificially at a level, but at the end of the day, it's going to the sea, and it goes a whole bunch faster, a whole bunch quicker when you do the dam wall, because the dam wall breaks and then the pressure's too much. So it's a very, very valid point. And I would further to add to Brent's point saying the longer they disproportionately hold a mispriced and they don't let markets pricing mechanisms work, the greater the subsequent move. Now, don't forget, this has been a 40-year peg, but the pressure really is coming on now. So it just becomes they store up a bigger move because they'll have less resources, they'll be leaner, and there'll be complete capitulation. So in that sense, a strategic withdrawal early is smarter. And I'm betting that the Chinese and the Hong Kong Monetary Authority are potentially smarter than what the Euro Swiss franc SMB performance showed, that holding a 1.5 was always ridiculous. They let it go. Holding a 1.2 eventually saw them got leaned. You just keep storing troubles up and it ends up costing you a whole bunch more. So that is almost you've hit the nail in the head by highlighting that point. This is you're bringing to highlight essentially what we're thinking is coming. Also, for people that just to understand some of the basics, the carry trade is the difference between the Hong Kong International HIBOR and the dollar, which is LIBOR for now, although that is also put under pressure to pivot away from LIBOR as well. There's the geopolitical uncertainty we've touched on, the financial center stark revenue, just a data point for everyone. Half year to 2022, IPO listing revenue is 1/10 of what it was previously for the same half year. So the financial center as a revenue point is just not there anymore. And people are voting with their money. Who wants to list their equity in Hong Kong with that level of instability?
This is key because IPOs is a key way that Hong Kong would get capital from the rest of the year or from the rest of the world.
Yeah.
Right. And in order to maintain the peg, they need capital inflows to continually replenish the reserves. If IPO listings are down 90%, that capital from the rest of the world is not coming in and replenishing the reserves that are being spent to defend the peg.
Brilliant and absolutely correct. And well done for underlining that. And the other point that I only recently really thought about or learned from others through reading materials around this is the liquidity reduction within Hong Kong that the cost of defending the peg does. Because from May 11th through to late July, the Hong Kong Monetary bought 172 billion of Hong Kong dollars, 22 billion in US, shrinking the balance of Hong Kong dollars liquidity amongst banks too. So you're actually getting a reduction in liquidity in their own nation state, if we were to call it. I think it should be deemed a province of China more than a nation state. That's almost inevitable. But that liquidity effect leads us on their own housing super housing rates, wow, in Hong Kong, they were very, very overblown. The tighter the liquidity pushes up the local Hong Kong borrowing rates. So they then get a massive lean on the housing prices in Hong Kong. One of the most speculative assets, I would say, in terms of what I've read in China, what's gone on, and a small sidebar on Evergrande, they were taking deposits and taking payments for property just off land bank that they'd done a brochure of developments, and that money, instead of utilizing it for building, they were securing further land banks with. And you've actually seen bank runs and people reluctant to pay any further payments on Chinese property on the basis that there wasn't any building going on. So now people are holding back the funding, and the Chinese are now trying to coerce the banks into lending. You've had 86 provinces with bank runs going on, with people queuing outside. So people don't understand, because it's not in your daily feed, the extent of pressure. China has gone and done a magnified version, if that was even possible, of the GFC property boom that the West did. Only the leverage and the skullduggery and the corruption is X level up. So the scale of the downdraft that they face for creating the heat in our post-GFC global economy is absolutely extreme. Then you've got the zero COVID policies. This has been highly economically destructive, no matter what you think regarding the pandemics. You've got a massive amount of bear planets all aligning. You've got Hong Kong resident departures. So you've got a situation, zero COVID type policy, very restrictive, businesses in trouble, people can't move around near as much. They continue to weigh on the economy, hurting your employment, low financial services revenues, low IPOs. On top of that, an overvalued property sector under pressure from people leaving. So you've got a sales cliff, an overhang. You've got political reasons of people wanting to be out of there. That's further contributing to a steady ongoing stream out of there, plus an environment where local interest rates are going to go significantly higher because of protecting the peg as well. They're reducing liquidity. This is just a catastrophe of events. It's called the bear planets all aligning for me. And then to Brent's point that he brought out earlier, almost stealing some of the thunder of this, but I'm a great believer it's not official until it's officially denied. And the Hong Kong's de facto central bank, Eddie Yu, said the peg has worked very well for 40 years and there's no plans to change it. And that rang the bell for that very point that Brent made about the Swiss National Bank in December, just before Christmas, saying it was central to their policy, and then walking within 3.5 weeks. The 14th of January, the peg failed in 2015, after saying in late December 14 that it was central to their policy. So the fact that he has to comment is the indicator, not the content of what he says. He talks his book and serves his masters. So that content is always going to be in that line. But the fact that he needs to comment is your indicator of stress.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.